Hello, 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 hello. Good afternoon, good Tuesday afternoon, everybody. How are we doing? How's the sound? Can you hear me? Can you see me? All that good stuff. Yeah, thank you, David. Kevin, hello. Thank you, thank you, thank you. Wonderful. Hey now, Gus. Hey now, hey now. All right. Market after being down, little bit this morning, I guess. S&P's down like 15, 16 on their lows. We just got back to actually not just unchanged, but slightly positive. Now we're slightly negative again, but really a big, big divergence in the market today. We've got the S&P's right around the flat line. We've got the NASDAQ down almost, well, it was down almost 1%. It's come back a little bit from there. And the Dow is up almost 1%. So maybe it's a little bit of sector rotation. Some of the NASDAQ stocks that have been on fire, maybe taking a little bit of a breather, like NVIDIA and Microsoft. Those two are really leading the downside. And then obviously Tesla with the spat between Elon and Donald Trump. Would anybody love, I think I mentioned this once before, would actually anybody love to see those two in a cage match, right? A WWE cage match or WWF cage match? That would be just awesome. Would love to see the two of those guys duking it out. Anyway, here we are. Summer trade, holiday week. We've talked about this. We know got today, tomorrow, half a day on Thursday. Don't forget, markets close early on Thursday. Yeah, put the Zuckerberg in there too, David. That would be a good one. Half day on Thursday. Markets close at noon Central, 1 Eastern. And then everything is closed on Friday. So if everybody could smash that like, subscribe, all that good stuff, that would be great. Let's go get those smashers in there, guys. And then we are going to talk about something so important that we talk about really every day as we're trading. But what does implied volatility really mean? Okay, I know we always talk about it, and we know we want to buy it when it's low, we want to sell it when it's high, but how do we determine that? How do we know that, vol is high or low at a certain point? And how does it affect option pricing? Okay, so the first thing we have to delineate between, there's two types of volatility. HV, which is historical volatility, and then IV, which is what we really follow and watch so closely. That is implied volatility. Okay, historical volatility is in the rear view mirror. It is what has already happened. How has a stock traded over a certain time period, right? So that is actual data, what has happened in the rear view mirror. Implied volatility, which is what we follow, that is really more relevant for what we do than historical volatility for option pricing, because it's a look ahead into the future. And it's a look ahead based on what has happened in the past with historical volatility. But that is what implied volatility is. When vol goes up, it's really all just a function of supply and demand. So when implied volatility is going up, that means there is more demand for people buying options. When I say options, that means either calls or puts. Does not matter. There's a bigger demand than there is supply. So just like with anything else, any other widget to any other product in the world, when that happens, we see prices go up. And then when it's the flip side, when it's the opposite, when there are more sellers than there are buyers, implied volatility comes down. Option prices come down as well. We know that we will see volatility spike when there's an event. Okay, for an individual stock, typically leading into an earnings event, we will see vol spike, and we actually begin earnings season next week already, guys. Seems like we just, we're in the midst of one. The banks start next week, so that's going to be next 6 weeks or so worth of earnings. And the reason that we see volatility ramp up into earnings is because we know that on a certain day, that company is going to make an announcement that they don't make the other 89 days of the quarter, right? They are going to talk about the financial health results for that company. So when that happens, that 1 out of 90 days that happens, right? Well, we can all expect a more material impact to the stock, a bigger move in the stock. So that's why people want to buy options. Calls, puts, doesn't matter. Okay, so as that demand is ramping up, volatility is moving higher. And then as soon as that news is out, literally, as soon as that news is out, whether it is good, bad, or indifferent, what happens? Well, we see vol come crashing down because now the surprise or the unknown is now gone. Okay, so as would make sense, as we probably all know, when vol goes up, option premium goes up. When vol goes down, option premium goes down. Okay, but what actually changes in the price of an option when we're measuring that implied volatility and the change in that option premium? What are we actually measuring? That's a question for everybody. Hey there, Jake. How you doing? What are we actually measuring? Wait for some answers here. Awesome. Glad to hear it, Jake. Excellent. Robert, Jake, come on. Everybody else, you can chime in now too. You can hop on their backs because that is absolutely the right answer. What changes in the price of an option, the premium, is all the extrinsic value. Okay? The intrinsic value of an option does not get affected by volatility. It only gets affected by where the stock price is. Okay? It is that added amount of premium, which is the extrinsic value, which changes and gets affected by a change in implied volatility. Okay, so again, here's that, we always talk about the bell curve and we always talk about the standard deviations, especially when we're talking about expected move. Okay, but this is what happens, okay, to the expected move as implied volatility changes. So remember, when we look at expected move, what we're really monitoring or really measuring is this right here, this one standard deviation move, which in statistics happens 68% of the time. Okay, so this 68% of the time movement is going to expand and it's going to contract based on where implied volatility is and where that option premium is. Does everybody understand that? So whether vol is really cheap, really expensive, or in the middle, that one standard deviation still holds true. in terms of the expected move. What's up, Aladdin? How are you, man? Okay, good. Everybody understands that, right? And so it's really important, just like most concepts are, to understand implied vol in terms of expected move. As implied vol widens out or gets more expensive, that means the expected move is going to be greater, wider. As implied vol contracts, that expected move will be lower. Okay, so here's another way of looking at that extrinsic value, and I'm going to go through some real examples right now, but this is another way of looking at it. If we were to plot implied vol and extrinsic value, the higher the implied vol, the more extrinsic value there is. Okay, so let's look at an example here. Okay, Brad, I'm only choosing you because you're the last one that I see in the comments here. Give me a stock that you would like to look at. Does not matter what stock it is. All right. SE, you got it. Which happens to be taking it on the chin today. All right. Here is a chart in SE. Okay, here's stock chart. Big decliner today happens to be right down to the 50-day moving average. But if we expand this and bring in implied volatility, we can see even with this little increase in implied vol over the last day or so, where it has, the stock has been under a little pressure, vol overall is still really cheap. And when we look at an implied volatility chart like this and we see these peaks and valleys and peaks and valleys, we can pretty much identify that those big peaks are probably right around earnings time. And we also notice that regardless what happens to the stock price, as soon as that news is out, we see volatility plummet. And the one really, really, really big concept to remember with implied volatility is that it is always mean reverting. Okay. It is a statistical, it is not a statistical anomaly. It is really, I guess you could call it a fact that when we get up here, vol is going to come down. And when we're down here, vol is going to come up, and it is going to find its surface level. It is going to find what is the average or normal implied vol. Okay, and that will happen whether you're looking at an individual stock, whether you're looking at an index, whatever it will be, implied volatility always normalizes or mean reverts. Okay, so now let's bring in an option chain here for SE. Okay, and we'll look at this just with at the money options. We can look at it with any of them, but we'll look at the money options here. So the stock is trading basically 152-ish. So we're going to focus in on next week's 152 and a half. Okay. If we were to look at this right here, what do we see as the expected move for SE going out to next week? Okay. Anyone else? Okay. Oh, we got 7, 8, 665. So we definitely have some different answers here. I mean, if I'm looking at just the, you know, the straddle, the 152.5 straddle, it's really about $7.50. 7 to 8 is a good range. Yeah, 7 and change. So we'll call it $7.50. Now, it's $7.50 with implied volatility being right at about 37%. Okay, does everybody see that? So with implied volatility right around 37%, the expected move is $7.50. Now, if we go back to our implied volatility chart and we look here, 37 is, kind of right where we are right here. That's still pretty historically very cheap. So if you were to look at that, and regardless of the position you would want to take, whether you're bearish, you're bullish, you're neutral, okay, I would look at this and say, wow, vol is really cheap. I want to buy some time. Because when vol is cheap, time is on sale, premium is on sale, that extrinsic value is on sale. Okay, now, when I talk about the extrinsic value and implied volatility, let's go back to the option montage here for a sec. Okay, and we're in a live market, so the stock is going to keep moving around, but the stock now at 151.30, okay, the 152.5 put is essentially $4.20. Okay, does everybody see that? So on this 152.5 put, how much intrinsic value is there? And how much extrinsic value is there? Okay, intrinsic first. 151.30 and $4.20 on the put. How much intrinsic value is there? Okay, Steve, you say there's $3. Okay, anybody else? Come on, guys. So a lot of you out here, I know you got to be, okay, Aladdin, you say there's also $3 of intrinsic value. Okay. Anybody else want to give a gander? This is intrinsic value. Okay. Really? Okay. If you own the 152.5 put, what does that allow you to do? What does that allow you to do? Sell. Okay. At what price, Kevin and Gus? At what price? Thank you, Bill. Thank you. Thank you. Thank you. Thank you. If you own the 152.5 put, you can sell stock at 152.5, right? Well, if you're able to sell stock at 152.5 and the stock is trading 151.30, what is the intrinsic or the real value to that put option? Thomas, you got it. The intrinsic value is $1.20. You're able to sell stock at 152.5. You can buy it back at 151.30 in the open market. That means the intrinsic value is $1.20. So everybody that said $3 before, do you understand? The intrinsic value is only $1.20. The extrinsic value, all of the extra or added premium, okay, that would be $3. Because if the option's trading $4.20 and there's $1.20 of real or intrinsic value, that leaves $3. I figured as much, Steve. Does everybody follow that? Okay, so what kind of bearing does that have on how implied volatility changes the price of an option? Well, let's go in, and instead of seeing the implied vol here being 36 or 37%, what if I'm able to go in here and make it 42%? Okay, watch what happens to the change in the value of this option. Look what happened there. Look what happened. That still does not affect the intrinsic value. The intrinsic value is going to be whatever it is, the real value. So it only affects the amount of premium or the amount of extrinsic value, right? That's what we always have to be thinking, guys, when we're looking at trading implied volatility, whether we're looking to buy it when it's low, as we see down here, or sell it when it's high. That's what we have to realize. It's that premium amount that we're either buying on sale cheaply or selling expensively. So it is all about the extrinsic value. Now, which options have the most extrinsic value? At the money options have the most extrinsic value. And then the further you go out either direction, either further in the money or further out of the money, that extrinsic value declines, it decreases, it becomes less and less and less and less. So the further in the money you go, most of the price of that option is just the intrinsic value, very small amount of extrinsic value. And then the further out of the money you go, well, there's not going to be any intrinsic value if we're out of the money. It's only going to be premium or extrinsic value, but it's just going to be a teeny amount. And let's take a look back at SC again and compare it. But before we do that, let's get Thor's word of the day here, which happens to be vol. So everybody get your vol up in the chat box here, please. Okay, give it another minute or so here. There we go. Okay, so let's go back here and let's bring our handy dandy option montage back into sight. Okay, and with SC, again, we're right around 151. Okay, so let's look at the 150 call right now. We were looking at the 152.5 put. Let's look at the 150 call. So $4.40 with the stock, 151.10. How much intrinsic and extrinsic value at those prices? So the 150 call has how much intrinsic value? How much intrinsic value there, guys? Gus, that's the intrinsic value. There's $1.10 of intrinsic value there, not extrinsic, right? Because if you own that 150 strike call, that allows you to buy stock at 150. If it's trading 151.10 in the open market, that's $1.10. Everything above that, or in this case, $3.30, would be the extrinsic value. Okay, now let's compare that, the amount of extrinsic value there is, to a really deep in the money option. So let's look at the 120 strike call. Okay, the 120 call trading $32. Okay, how much extrinsic value is there in this call option? And let's say it's trading 32 with the stock 151.40. Okay, how much intrinsic, how much? There you go. Okay, yeah, Kent, I changed the values on you a little bit, but you got it. You can see here, if we use these prices right here, the intrinsic value would be 31.40, and there's only then 60 cents of extrinsic value or premium. Far, far less than the at the money option, which had $3.30. Does everybody see that? Okay, now if we go the other way to a really, really deep out of the money option, let's go to the 160. Let's go to the 165. Actually, let's go to the 167.5. There's a market here. The 167.5. How much intrinsic value on the 167.5 call? And the wheel is closed. How much intrinsic value on the 167.5 call? Good, Gus. Zippo, 0. There is no real value to that call, right? Because you would never exercise that call. You wouldn't want to buy stock at 167.5 when the stock's trading 151 and change. So there's 0. And so whatever price that option is trading for, 20, 25 cents, whatever it is, that is just extrinsic value. So again, you could see far in the money or far out of the money has very small amount of extrinsic value. It's that at the money area that gets affected most by a change in implied volatility. Does everybody understand that? The penny finally dropped. I love that. Good, 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 good. All right. So here's what we're going to do, guys, because I have a lot more to talk about this. I have a bunch more slides here to talk about this, but we're already half an hour in. So we'll pick this up tomorrow. We'll continue this discussion tomorrow. One thing I want to leave you with before we go to the wheel, okay? Tonight. Great song by Genesis, by the way. Mike Shore will be hosting a live Webby tonight. Okay, it'll be talking about his short-term options, but bringing AI into it. Okay, so it'll still be centered on day trading, but it is now bringing in the wonder and the art of AI. If anybody has any interest in listening to Mike tonight to see what he's doing in his room, especially with bringing the AI system in, I just put a link in the chat. You can log on or you can register right there. All right, guys, let's get to today's wheel. Yesterday's winner, wish I could remember. I know it was with Geo, it was George. That's right, because it was really, 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 really close to being Gene, I think it was. Thank you, Aladdin. We appreciate that. Oh, packed wheel today. Great. Great. So, George, if you're on here somewhere, which it doesn't look like you are, so we must have already kept you off, you couldn't win anyway. And here we go. Vincent, or what your options are, or Ty. Vincent is the winner today. Vincent, are you in the house? Vincent, are you in the house? Yeah, that was a quick response. Awesome, Vincent. All right, we will post up here the email address to send me your information, swag size, and your address. There it is right there. Way to go, Vincent. So again, tomorrow, guys, we'll pick it up right from where we left off today. And where we left off was at the money options have the most extrinsic value. So when there is a change in implied volatility, it's going to affect at the money options more than it's going to affect the options on the outers, either far in the money or far out of the money. Thank you, Jake. Much appreciated. Okay, again, couple things. Mike Shore, Webby tonight, 7 o'clock Central, 8 o'clock Eastern. Markets close early Thursday, noon Central, 1 Eastern. Markets closed on Friday. Everybody have a fantastic day. We'll see you tomorrow for part 2 of Implied Vol. See you later, everybody.